Welcome back to the deep dive. You know that feeling when the entire market just seems to defy gravity?
Yeah, it's been kind of wild lately.
That's exactly where we are right now. 3 record highs in a row for the Dow, the S&P 500, and the Nasdaq Composite. All of them notched their third straight day of fresh record closes as of Monday, September 22nd. This run is, well, it's pretty extraordinary, and the momentum feels utterly unstoppable sometimes.
It really does. It's an atmosphere of almost pure technological exuberance. But this rally isn't just happening on its own. It's being driven by uh, a rare alignment of forces. You've got this relentless optimism around AI, the whole revolution there.
For sure.
And that's coupled with some pretty significant tailwinds from a newly dovish Federal Reserve.
Huh.
That's easing financial conditions globally.
Okay, so that dual driver really sets up our central question for today, doesn't it? We have to sort of wrestle with this core contradiction. Is this momentum actually justified by, the next great era of corporate productivity? Is that what the world's most valuable companies are pricing in?
Or is it the other side of the coin?
Or conversely, are we looking at historical valuation levels that suggest the market is just dangerously overextended? Like, are we really back to dot-com era PE ratios?
And that tension, that push and pull between the technological promise and the financial reality, that's probably the most important story in the market right now.
So our mission in this deep dive is to unpack the source material covering this. We'll look at the biggest corporate power moves, right? Like Nvidia's massive bet.
Yep, got to start there.
Then we'll dig into how high-stakes domestic and geopolitical policy decisions are actively moving stock prices.
Because they definitely are.
And finally, we'll square the macro risks, inflation rates, those historical valuations, against all this optimism that seems to be everywhere.
Sounds like a plan. Let's dive in.
Okay, let's unpack this and start with a headline that basically confirmed AI is still the absolute rocket fuel of the global economy. That $100 billion commitment from Nvidia. You really just cannot talk about this market run without talking about Nvidia. NVDA's stock surged nearly 4% on Monday, closing at yet another record high.
Another one.
But this wasn't just some technical momentum, was it? This was driven by specific massive news.
Yeah, concrete news. Nvidia announced plans to invest up to get this $100 billion in OpenAI.
$100 billion, wow.
What's really crucial for listeners to understand here is that this isn't just Nvidia cutting a check as a passive VC investor.
Right.
This is highly strategic. It's a foundational infrastructure build that essentially locks the world's leading chipmaker into a long-term deployment partnership with the world's leading generative AI company.
So deep integration.
Deep integration on a scale we really haven't seen before.
And the partnership details, I saw the Reuters report, they clarify this. It involves a letter of intent for deploying a staggering amount of compute capacity.
That's right. The partnership aims to deploy at least 10 gigawatts of dedicated NVIDIA compute capacity.
10 gigawatts.
10 gigawatts. And the first major phase is targeted to come online in the second half of 2026.
2026. So think about that time frame. We're talking about capital being allocated now based on monetization expectations, nearly 3 years in the future?
Precisely. It's a long-term bet.
10 gigawatts.
Yeah.
That figure is it's staggering. Can you put that into perspective? How much power is that really? What does it mean for logistics in 2026?
Okay, so 10 gigawatts of dedicated computing power, that's enough to power several small cities. Or think maybe 7.5 million homes continuously.
Wow.
It fundamentally shifts the infrastructure game. This isn't about buying a box of chips anymore.
No.
It's about building entirely new proprietary data center infrastructure optimized just for advanced AI models. And OpenAI's CEO, Sam Altman, he really nailed it when he said, everything starts with compute.
Yeah, that quote stood out.
And when the most ambitious AI company says that, and their main supplier commits $100 billion to guarantee that compute supply for years, well, it basically removes all doubt for Wall Street about the longevity and the financial viability of the AI demand curve.
So if that's the commitment at the very top, that confidence just immediately cascades down the supply chain, doesn't it?
Absolutely.
We saw an immediate ripple effect into other crucial components, specifically memory chips, right? Micron, MU, they're reporting earnings after the bell on Tuesday.
Micron is definitely the bellwether for the memory chip industry.
Wow.
Analysts are looking for an almost 40% year-over-year jump in sales in their report.
40%.
Yeah. And investors are going to be scrutinizing that report for detailed updates on AI-driven demand, specifically for HBM high-bandwidth memory.
which is essential for Nvidia's GPUs.
Exactly. It works alongside those flagship GPUs. So if Micron comes out and validates that the demand is robust, it signals that the entire chip supply chain, not just Nvidia, is really benefiting from this AI boom.
Okay, then you look even further up the supply chain to the companies making the incredibly specialized machinery that allows these chips to even be manufactured. I'm talking about ASML.
Ah, yes, the Dutch giant. With the EUV, the extreme ultraviolet lithography machines.
Exactly. Their shares jumped sharply after Morgan Stanley upgraded the stock, right?
Yeah.
And lifted the price target dramatically.
They did, from 600 euros up to 950 euros. That's a big jump.
Huge jump.
And the analysis really hinged on building order momentum that they expect to solidify before the end of 2025.
Okay.
Specifically for delivery in late 2026 and into 2027. So again, we are essentially seeing analysts buy into earnings projections based on orders that won't even be filled for several years.
It's kind of remarkable, isn't it? It's like we're buying furniture based on the floor plan for a house that hasn't even broken ground yet.
That's a good analogy.
That degree of foresight is either, I don't know, revolutionary or incredibly speculative. But ASML, even though they dominate, they face concentration risks, don't they?
Oh, absolutely. The main risk highlighted in that analysis is ASML's continued reliance on the big one, Taiwan's semiconductor manufacturing company, TSMC.
Right.
Now, while TSMC remains robust, the analyst did note weakness in other potential major customers like Intel and Samsung. They estimated a near zero sales contribution from Intel and only modest sales from Samsung, probably due to delays in their own manufacturing processes.
So if ASML sales become overwhelmingly reliant on just TSMC, that single point failure risk, especially with all the geopolitical tension.
Exactly. That could definitely threaten that bullish view down the road.
The extreme precision needed by ASML's machines really shows the technological barrier to entry in the chip space. But that $100 billion compute plan, it immediately brings us back to a much older, much more physical barrier.
Yeah.
Just raw power.
Yeah, you can't run these things without electricity. A lot of it.
How does 10 gigawatts fundamentally change the energy landscape?
Well, it creates enormous, stable, and frankly non-negotiable demand for power. This skyrocketing demand for data center power is directly fueling the rally we're seeing in nuclear and other large-scale power generation companies.
Like Constellation Energy.
Yep, Constellation Energy CEG already up over 50% year-to-date, and Vistra, VST. Both rallied significantly on Monday after some bullish analyst calls came out from Scotiabank.
And Scotiabank explicitly tied those ratings to the AI build-out, didn't they?
They did. The analysts are projecting massive long-term demand for stable power. They noted that data centers need 247 baseload generation.
Makes sense.
And this plays directly into the strengths of nuclear energy providers like Constellation. They provide highly reliable power, plus it has a lower carbon footprint, which is a bonus for the hyperscalers like Amazon or Google who care about that.
So it really shows how deep this AI ripple effect goes. It's moving the market from like the nanoscale manufacturing process all the way to the literal power grid infrastructure that takes decades to build.
It's connecting everything.
Okay, so moving from the technological catalyst to the political one, we saw some huge market swings based purely on White House diplomacy and regulatory action this week. Let's start with Oracle, or CL.
Right.
Shares jumped over 6% on Monday. And that completely reversed an earlier dip they had related to some internal company restructuring.
Yeah, Oracle's performance is really a perfect case study in how regulatory policy and, geopolitical positioning can just completely override whatever internal corporate news is happening. The initial dip was because of a CEO shakeup. They replaced Safra Catz with two new co-CEOs to lead their specialized AI, cloud, and industries business. But honestly, that story just vanished.
Right, vanished when the White House officially confirmed the specific details of the new TikTok deal.
Exactly. And the details of Oracle's role in this deal are, well, they're far more complex than just a simple data hosting contract. It's really a core national security function now.
Yeah, explain that.
So the White House confirmed the new TikTok deal will move U.S. operations into a U.S.-controlled joint venture. China's ByteDance gets relegated to a minority holding, less than 20%.
Okay.
And Oracle is named the security provider. But their task goes way beyond just storage. They have to fully inspect, and this is crucial, retrain a copy of TikTok's incredibly valuable content recommendation algorithm.
Wow.
Using only U.S. user data.
That algorithmic control piece is the really sensitive part, isn't it? That recommendation engine dictates what, like 150 million Americans see every day?
And its crucial value is just astronomical.
So the arrangement requires that this retrained algorithm has to be regularly inspected by U.S. government officials.
That's the plan. It's designed to satisfy every security requirement. One White House official even stated they feel this meets every security requirement that we need for the algorithm to make sure it's behaving appropriately and is completely walled off.
So for Oracle, this is a strategic coup, basically.
Oh, huge. One Morningstar analyst estimated that the initial TikTok deal already accounted for about 5% of Oracle Cloud Infrastructure, OCI, revenue in its 2025 fiscal year.
Wow, 5% already.
Yeah. So securing the inspection and the retraining of the core algorithm, it just reinforces OCI as a platform that the U.S. government trusts for really high-stakes, sensitive data operations.
Okay, so that's domestic regulatory policy moving tech.
Yeah.
Now let's turn to pure international trade policy. Aerospace giant Boeing, BA, got a significant lift based on diplomatic maneuvers.
Right. Boeing stock rose over 2% in pre-market trading on Tuesday. This followed news that negotiations for a huge China aircraft order are in the final stages.
A huge order. We're talking big numbers.
Potentially massive. Could be for 500 aircraft, worth tens of billions of dollars.
500 aircraft. And this order has been sort of sitting in limbo for years, hasn't it? And it's being viewed as maybe the potential centerpiece of a broader U.S.-China trade deal, something to cool tensions.
Yeah, this is classic plain diplomacy, as they call it.
Yeah.
It would end a sales drought for Boeing that stretches all the way back to 2017. U.S. Ambassador David Perdue emphasized the high-level geopolitical component here. He noted its importance to the president, to Boeing, and also to China's economy.
So it's more than just a simple purchase order.
Oh, yeah. In these massive commercial deals, corporate wins like a 500 aircraft order are often the high-profile centerpiece that lets political leaders claim a trade victory.
Okay.
They leverage a corporate sale as a negotiation tool for broader diplomatic goals. In this case, maybe easing tariffs or trade restrictions in other areas.
Interesting. We also saw new policy introduced this week regarding labor. The Trump administration announced a massive fee hike for certain work visas, specifically the H-1B.
Yes, the administration announced a new $100,000 annual fee for H-1B work visas.
Per visa. Per year.
Per visa per year. And those are heavily relied upon by the U.S. tech industry to get highly skilled international talent. This policy prompted immediate and pretty urgent warnings from firms like Microsoft and Goldman Sachs to their international employees.
Okay, a $100,000 fee seems like a massive new operational cost. But the market reaction was kind of muted.
It was surprisingly muted, yeah.
The big tech megacaps, the Magnificent Seven, they largely just shrugged off the news, traded steady in pre-market. That seems counterintuitive.
It's actually an incredibly insightful signal about where investor priorities are right now.
How so?
It basically demonstrates that for the Magnificent Seven, labor input costs, even massive new ones imposed by policy like this, are currently being dwarfed by the projected AI revenue growth and this belief in labor-free scale. Investors are essentially betting that the productivity gains from AI will soon reduce the reliance on labor anyway, or at least that the revenue generated by these skilled workers vastly outweighs that $100,000 fee.
So the stock price momentum suggests investors are prioritizing future AI revenue over immediate labor input costs.
That seems to be the read, yeah.
Okay, so we've got AI driving future revenue. We've got policy creating specific trading opportunities. But the third massive driver, and maybe the most important macro signal, is the Federal Reserve. They've basically given this rally the green light by turning explicitly dovish.
That dovish pivot is really the bedrock of the current market mood, isn't it? The Fed lowered rates for the first time in 2025 just last week.
Right.
And that action fundamentally fueled the latest leg of this rally. And crucially, Wall Street is already anticipating 2 more quarter-point rate reductions before the end of the year.
2 more this year.
Yeah, the market is fully pricing in a sustained easing cycle.
So our immediate focus now shifts to the key data points that will either confirm or maybe deny those expectations. We've got Chair Powell scheduled to deliver a major speech on Tuesday.
Okay, we'll be listening to that.
Definitely dissected for any hints of tightening language. And then on Friday, we get the Fed's preferred inflation gauge, the Personal Consumption Expenditures Index, PCE.
And investors are desperately hoping for a weak print there. A tame reading on the PCE gauge would likely lift the odds of another rate cut, maybe as soon as October.
But the consensus isn't perfect, right? What are analysts expecting?
Well, consensus is expecting core PCE inflation to print at 0.2% monthly, which still leaves the annual rate pretty elevated at 2.9%.
Still almost 3%.
Still almost 3%. And that 2.9% is still technically above the central bank's long-stated 2% target. So the inflation problem hasn't completely vanished, even if the Fed is starting to ease.
And that sticky inflation is exactly why we heard some caution from Fed officials, even right after the rate cut, isn't it?
Absolutely. St. Louis Fed President Alberto Musalem, he reiterated the need for caution, stated publicly that he sees limited room for more reductions given the elevated price pressures and the underlying economic strength.
So they're walking a tightrope.
A very tight line between easing financial conditions to maybe ward off the real prospect of rising unemployment, as one source put it, and making sure they don't reignite inflation by moving too quickly. The market's betting on the first part, but the central bankers are still clearly worried about the second.
Okay, let's look at how this rate cut environment impacted other asset classes, especially those sensitive to lower interest rates. Gold, for instance, non-interest-bearing asset, have a remarkable run.
Gold is just screaming confidence in this easing cycle. Gold futures, GCF, hit a fresh all-time high, topped $3,750 an ounce.
Wow, $300 and $750.
It's up over 40% year to date. It's tracking for its best annual gain since 1979.
1979, that's saying something.
Yeah, a period of intense inflation fear, geopolitical uncertainty. Lower rates just make holding bullion, which yields nothing, relatively more attractive compared to fixed income like bonds.
And this surge is being driven by...
Massive ETF inflows, mostly, and just the general feeling that the rate-cutting cycle being firmly on the table.
Okay, but the contrast is stunning when you look at the crypto market. You'd think an easing Fed, usually associated with the risk on sentiment liquidity, that should send Bitcoin and Ether soaring.
You'd think so.
Instead, we saw a rout.
Yeah, we saw the classic case of sell the news, and it was really exacerbated by leveraged positioning. Bitcoin fell 3%. Other tokens dropped sharply after the rate cut announcement.
After the announcement.
And over Sunday night, traders liquidated a massive $1.7 billion in bullish wagers across the crypto derivatives market. And what's really telling is that 94% of those liquidated positions were leveraged long bets.
Leverage.
Yeah. It suggests the market had already fully priced in the cut, so when the expected event actually happened, it just triggered this massive cascade of profit-taking and margin calls. Wiped out bets on Ether and Bitcoin specifically.
So this divergence is interesting. Gold reaching historical highs, signaling maybe fundamental uncertainty, while crypto sells off on liquidity news. It's a powerful signal about where maybe institutional investors see real safety in this easing but still uncertain macro environment.
It does seem to point that way.
But let's bring it back to the S&P 500 because all this optimism is happening despite some truly worrying historical valuation numbers.
And this brings us to the most critical caution point, I think. Despite all the compounding risks we've talked about, tariffs, labor policy uncertainty, rising unemployment risks noted in the source material.
Yeah.
The S&P 500 is now trading at valuation levels we've only really seen during the most extreme bubbles. Its price-to-earnings ratio, specifically the one based on trailing 10-year average earnings, the KPE or Shiller PE.
Right, the Shiller PE.
It's now a staggering 40x.
40 times earnings. Just to put that in historical context again, that level has only been sustained twice before, right? Peak of 1929 market mania and the 2000 dot-com bubble.
That's the company it's keeping, historically speaking.
So if the math requires, 15% growth in 2027 just to maintain the current price, isn't that scenario immediately threatened by the tariff and unemployment risk you just mentioned?
Yeah.
How do the sources reconcile that huge contradiction?
Well, they don't reconcile easily. That's why the tension is so pronounced right now. The cold, hard math shows that for the S&P 500 to simply maintain its current estimated earnings multiple, its aggregate earnings need to grow by 13.4% in 2026.
Oh, yeah?
And then another 15% in 2027.
15%.
The consensus view is that investor confidence must remain well above average over the next 2 years. We are not just pricing in tomorrow's profit, we are pricing in a perfection scenario years in advance. There's really no room for error or any kind of recessionary slowdown.
That's the cold, hard math of the valuation danger zone. But let's play devil's advocate for the bulls for a second. There is a very strong counterpoint, isn't there? From bullish strategists who look at that 40-pay SPE and say, hey, this isn't your grandfather's S&P 500.
Right.
They argue the comparisons to 29 or 2000 are structurally flawed.
And that argument suggests that historical comparisons just fundamentally fail to account for the composition of the modern index. These strategists cite several unique factors they think justify this premium. First, the massive concentration of the index in high-growth sectors, like tech and communication services. That means the overall growth rate should structurally be higher than in the past.
Okay, composition matters.
Second, they point directly to those AI-driven productivity gains we talked about, arguing these efficiency improvements will lead to unprecedented margin expansion that just has no historical parallel.
And finally, they emphasize corporate profitability itself,
Yeah.
the resilience.
Exactly. They argue that modern high-growth tech companies benefit from network effects, platform dominance, and margin resilience in ways that, frankly, 1999 companies did not.
Hmm.
Corporations have maintained exceptionally high profit margins, successfully navigating the shocks of the pandemic, high inflation, and tariffs. So the bulls believe these durable margins justify the higher structural premium. They're suggesting the current high forward earnings multiple, which is around 23 times, is sustainable because this era of margin expansion is itself sustainable.
Okay, and the Magnificent Seven are really the engines driving that growth story and justifying that concentrated growth argument. Maybe we should quickly clarify who we mean when we use that term, just for anyone new to this deep dive.
Sure. The Magnificent Seven refers to the seven largest, most influential tech-related companies that have been responsible for the vast majority of the S&P 500's returns over the last couple of years.
Right.
That's Apple, Microsoft, Alphabet, Google, Amazon, Meta, Nvidia, and Tesla. Their collective strength is really what's keeping the broader index buoyed. And notably, all seven are currently positive year to date.
Okay, let's look at two specific names that had major catalysts this week, starting with Apple, AAPL. They were actually the last of the seven to erase their 2025 losses.
Yeah, Apple rallied over 4% on Monday. Big catalyst was a massive upgrade from Wedbush analyst Dan Ives. He raised the price target from $270 up to $310. That's the highest on Wall Street right now.
And the reasoning is mostly future-looking.
Almost entirely future-looking. It points to the anticipation of the new iPhone 17 lineup launch that's expected to catalyze a major consumer upgrade cycle.
How big is that potential upgrade cycle they're forecasting?
Well, they estimated that a staggering 315 million iPhones out of the 1.5 billion globally haven't been upgraded in the last 4 years.
315 million. That's a lot of phones.
It's a huge potential market. So that potential consumer refresh cycle plus expected AI integration and design enhancements in the new models, that's viewed as the magical formula that's pushing Apple back into that leadership position within the Mag 7 group.
Okay. Meanwhile, Tesla, TSLA, is continuing its own impressive run, hit a new 2025 closing high, up over 30% in just the last month.
Yeah, Tesla's momentum is fueled by a combination of things. Corporate actions, future vision. We saw CEO Elon Musk's publicly disclosed $1 billion share purchase last week.
Right. That sends a signal.
Definitely reinforces executive confidence. And you couple that with the continued optimism around the company's robotaxi expansion plans beyond Austin and the progression of the new compensation proposal. Investors are piling back in, betting heavily on that long-term autonomous driving pivot.
So this sustained high momentum across the Mag 7 really suggests a specific short-term positioning for traders right now, doesn't it?
Oh, absolutely. Short-term traders are definitely riding the NVDA wave and the broader AI theme. The clear strategy seems to be looking for bullish setups in Nvidia itself, or maybe in related semiconductor ETFs, using defined stop losses, of course.
Gotta have stops.
Always. But given the size of the current run, short-term momentum trading really requires constant vigilance. You have to watch for any signs of profit-taking or sudden reversals.
Okay. And for those focused more on specific news events, the volatility generated by policy, by earnings, that creates opportunities for swing trading too.
It certainly does. Catalysts like earnings reports, like Micron's coming up on Tuesday, they're perfect for swing traders looking for defined movements based on that AI outlook. Right. Similarly, look at Oracle's stock, ORCL. It demonstrated huge volatility around that CEO shakeup, followed immediately by the TikTok policy confirmation. That created two distinct tradable movements within just a 24-hour window.
Okay, but let's just return one final time to the long-term perspective. We noted those extreme valuation levels at 40x PE. What implications does this hold for a long-term, maybe non-trader investor?
Well, it mainly means proceeding with a heightened level of caution. While the valuation is extreme, we do have to consider that bullish counterargument that this isn't necessarily a bursting bubble yet.
Right, the timing is tricky.
Exactly. Strategist Michael Hartnett, who tracks historical manias, suggested that if this is indeed a bubble, it might not be ready to pop just yet. He pointed out that the Magnificent Seven stocks are up 223% since their March 2023 lows.
Okay.
Which is actually still slightly short of a historical bubble average gain of 244% from the trough to the peak. So statistically, there might still be a little room left to run.
However, given that requirement for 13% to 15% earnings growth in the coming years, just to maintain current prices, chasing these all-time highs still carries significant risk for a long-term allocation, doesn't it?
Substantial risk, yes.
Mm-hmm.
Longer-term investors who are considering adding to their core positions at these record levels should absolutely be looking at utilizing risk hedges,
Like what?
maybe through put options or inverse ETFs, or just sticking strictly to disciplined dollar-cost averaging to mitigate the risk of buying the absolute peak.
Makes sense.
The market is pricing in sustained perfection years out. That offers basically zero margin for error if something goes wrong.
Okay, before we wrap up our main analysis, we should probably mention one signal of shifting global investor positioning that suggests maybe some nervousness outside the U.S. equity focus.
Yeah.
The action in BYD stock over in Hong Kong.
Oh, yeah, that was interesting. A brief but potentially telling sign of large investor confidence shifts. BYD, the major Chinese EV manufacturer, saw its stock fall about 3.4% in Hong Kong.
And why was that?
Reports surfaced that Warren Buffett's firm, Berkshire Hathaway Energy, sold its entire stake.
Wow, entire stake. They held that for a long time, didn't they?
Over 15 years, they realized a massive gain, something like 4,500% since 2008.
Incredible gain.
Yeah. The sale is significant because it links global market action to these large strategic investor confidence shifts. And it raises questions maybe about internal competition or maybe the peaking of the Chinese EV market, which is a sector under heavy government subsidy focus over there. #tag outro. So to try and synthesize this whole deep dive, market optimism is currently winning out. Investors are placing these massive bets, like Nvidia's $100 billion compute plan, on unprecedented AI-driven efficiencies and earnings growth way out in 2026 and 2027. And this whole belief system is being backed up by a dovish Fed easing financial conditions. But that powerful optimism is currently stacked right on top of historically stretched valuations, levels we really haven't seen since the height of the dot-com era. And those levels require a guaranteed perfect execution of future growth.
Okay, and here's where it gets really interesting for you, the listener, and why we have to critically analyze all this incoming data. The S&P 500 is currently demanding, 15% earnings growth in 2027 just to stay flat at its estimated multiple?
That, basically.
It's pricing in AI success years from now.
Yeah.
Now, reflect on that gold trade we discussed earlier. Gold is hitting its best annual gain since 1979. Why? Because of underlying fears about inflation, the consequences of rate cuts, global economic fragility.
That divergence is absolutely key right now. One asset class is suggesting fundamental safety concerns and macro uncertainty.
All right.
The other is suggesting absolute technological perfection is just around the corner.
So that raises the final provocative question for you to mull over. If gold is hitting 1979 level highs due to macro uncertainty and rate cuts, while the S&P 500 requires perfect 2027 execution, which signal is telling you the more honest story about the underlying global economic health right now? The future might be priced in, but uncertainty is definitely still thriving at historic highs.
And as always, please remember, this deep dive is strictly for educational and entertainment purposes only. Nothing we discussed here should ever be construed as financial advice.
Absolutely. Always do your own research or talk to a licensed advisor before making any investment decisions. Until next time, keep digging and keep learning.